At the turn of the millennium, India's IT sector was booming. Companies like Infosys and Wipro were winning contracts worldwide, and the market was hungry for the next big name. In that climate, Satyam Computer Services, founded in 1987, rose to prominence, promising high growth and strong corporate governance, becoming a darling of both domestic and foreign investors. Satyam was the brainchild of B. Ramlinga Raju, a charismatic entrepreneur who built the firm from a small hardware shop to a $1 billion IT services company. By 2004, Satyam employed over 40,000 people and boasted a market cap of more than $10 billion, positioning itself as a credible alternative to the established giants. The company's business model centered on large-scale outsourcing contracts with US and European firms. Its audited financial statements showed steady revenue growth, soaring profit margins, and an impressive cash balance that attracted institutional investors seeking stable returns in the tech sector. Behind the glossy reports, Satyam was inflating its numbers. Internal investigations later revealed that the firm had fabricated about $1.5 billion in cash and $1 billion in revenue over several years, using fictitious invoices and bogus bank statements to paint a picture of profitability that never existed. The deception was enabled by a web of collusion. Satyam's auditors, Price Waterhouse, failed to verify the authenticity of the cash balances, while senior executives signed off on fabricated client contracts. This lack of independent oversight created a perfect environment for the fraud to flourish unchecked for nearly a decade. The house of cards began to crumble on 7th January 2009, when Raju posted a confession letter on Satyam's website. In it, he admitted to the massive accounting irregularities and claimed he was acting alone to protect shareholders, a move that shocked the nation and triggered an immediate crisis of confidence. The market reacted instantly. Satyam's share price plunged from around 500 rupee to under 100 rupees within days, wiping out roughly $1.5 billion in market value. Trading was suspended on the Bombay Stock Exchange, and investors scrambled to assess the scale of their losses. Regulators stepped in swiftly. India's Securities and Exchange Board, SEBI, launched an investigation, while the Ministry of Corporate Affairs introduced emergency measures to protect minority shareholders. The scandal prompted the passage of stricter corporate governance norms, including mandatory board committees and tighter auditor rotation rules. Foreign investors bore a heavy blow. Institutional funds from the United States, Europe, and Japan reported combined losses exceeding $800 million. The episode also led to a temporary slowdown in foreign direct investment into Indian IT firms as confidence in financial disclosures waned. The ripple effect hit the broader Indian IT sector. Competitors faced heightened scrutiny, and several firms voluntarily upgraded their audit practices. Clients re-evaluated contracts, demanding more transparency, while the Indian government intensified its push for global-level corporate standards. Legal outcomes were swift. Raju and several senior officers were arrested and later sentenced to prison terms totaling over 20 years. Satyam was rebranded as Tech Mahindra after a successful takeover by Mahindra & Mahindra, and the company eventually rebuilt its reputation under new leadership. The Satyam saga remains a cautionary tale about the dangers of weak governance. It underscored the need for independent boards, rigorous audit verification, and transparent reporting, principles that now form the backbone of India's corporate regulatory framework and continue to shape investor trust today.